Okay, well, in the interest of time, we might kick things off. So good morning, everyone, and thanks for joining us for this update with our emerging and frontier markets specialist, RWC Partners. I'm pleased to be joined this morning, our time, by John Malloy and Chem Akyürek from RWC's head office in Miami. It's actually now getting a little bit late in the evening over there, so we really appreciate you taking time out to join us, gents. Just in terms of the high-level agenda for the call today, we're going to do our best to stick to the 45 minutes that we suggested in the invitation. But clearly there's a lot going on in the world right now, and no shortage of talking points. So if we were on a few minutes over, then we apologise in advance. John and Chem have prepared some commentary on some of the key issues that they're looking at the moment. So we'll touch on those first, try and keep it to around 30-35 minutes, and then we'll move into some Q&A with you guys, the audience. So just as a quick reminder, you can submit questions at any time during the presentation. Just click on the question box at the top of your screen and type in your question, and we've already got a few coming through now, I can see, which is great. So keep them coming through, and we'll get through as many of those as possible. So just very briefly, for those of you on the call that haven't met John or Chem before, John Malloy is the lead portfolio manager of RWC's Emerging Market Fund. John has more than 26 years in the market. He's covered emerging markets from all angles. He actually started his career managing EM debt portfolios, which provided a pretty solid footing. And as you can see from the slide on the screen there, John leads a team of 18 professionals based across Miami, London, and Singapore. Chem Akyürek is also on the call. Chem leads on macro research at RWC. He's a senior member of the investment committee. Chem holds a Ph.D. in economics and specialises in quant and macro research. He spends a lot of time forecasting currencies and commodity prices, among other things, which can be particularly important in emerging markets, as you know. You can also see on the right-hand side of the slide there, RWC's advisory board. It's a pretty powerful resource for the team, led by Condoleezza Rice, particularly on some of the geopolitical and top-down issues, and I think John and Chem might share some of their thoughts at the moment as well, as we go through the presentation. So on that note, I might hand over to John now, and I suppose to kick things off, John, it's probably fair to say that we're currently witnessing one of the most challenging economic environments in recent history. Can you talk us through how you've managed the portfolio through, firstly, the steep drawdown that we saw in Q1, and then the subsequent rebound since, and maybe touch on some of the key changes that have been made to the portfolio?
Yeah, good morning. Thanks, Luke. Thanks to Channel Capital for having us. We really appreciate this opportunity. Yeah, clearly it's been an interesting, I would say, time, a challenging time. I actually was in Australia in February, as this was kind of unfolding, and then, kind of things really unwound pretty quickly. Early on, what we did was we started to look at the numbers very closely, especially in Asia. As some of you might know, we have a quant on the team, Alan Spies, and he did a lot of work in modeling out the virus, modeling out basically how it compared to SARS, MERS, other health crises that we've had. And, so we did actually start to shift the portfolio pretty quickly in March as we had that very sharp sell-off. I mean, the sell-off was probably the sharpest sell-off in history. I mean, the amount, the depth of it, the volatility, the downside, in a matter of, 4 to 5 weeks, we saw stocks collapse, 30, 40, 50%, some even more. And so you can see the chart in front of you, technology disruption, which has been a big theme of ours. At the end of last year, it was just under 20%. We took the opportunity to increase that exposure. That would be companies that are basically focused on e-commerce, digital payments, food delivery, cloud, companies, video streaming. So companies that, as you can imagine, as we go through the list, these companies are actually benefiting through COVID-19. These companies, their businesses are fundamentally better coming out of COVID-19. They're businesses that actually during the quarter had very, very strong results. Yet all those stocks that we added to, when you had that sharp sell-off. And we still have that exposure. We've taken it down a little bit. We also added to 5G. 5G is an exciting area where the Chinese have been very much focused on and will continue to focus on spending. Where we funded that, you can see a lot of that was EM travel, especially in China. We took down a couple of our Chinese names, and then we took down some exposure across the board. In terms of countries, we did take down Russia because as you saw that increased volatility in oil, and as we were overweight, we thought that Russia would continue to be under pressure. We're still overweight. We have about 5% versus the index at about 3%, but we also funded the increase in technology there. If we could look at the next slide, I think it's interesting, Matt. This is emerging markets and how emerging markets have fared COVID-19, and I think it's really important because if you pick up the FT or the Wall Street Journal, or I'm sure in your local media, emerging markets seem to be getting a pretty bad rap at how they're handling COVID-19. Brazil, Bolsonaro, India, Peru, and it's very interesting. We look at cases, but we look at deaths, and we actually think that deaths is more important than cases because what we're seeing even now with the recent upturn in China is that if you get it and you recover in 2 or 3 weeks, I mean, that's just like getting the flu. If you get it and die, it's a very, very different situation. And you can see that even Brazil, which has been getting the most negative publicity on COVID-19, the death rates in terms of deaths per million of population, far, far lower than the US, than Europe, than Italy. And if you look at the trajectory in terms of the path that they're on, it's very similar to all the other countries. Every country really has had the same path, and once you start to flatten out the curve, then you start to see that come down. And so we believe that emerging markets are actually in pretty good shape to weather COVID-19, despite this negative rhetoric that we're seeing. The unprecedented fiscal and monetary stimulus that's being put in place from developed markets will be very, very supportive for emerging markets. As Luke mentioned, I've covered emerging markets since the mid-90s, and emerging markets overall are in probably better shape than they ever have been in terms of current accounts, in terms of competitiveness of their currencies, international reserves. When you go down the checklist, basically, there are a few countries that really we worry about. South Africa would be one, Turkey would be another, but the complex overall, if you look at the emerging market complex, it's in very good shape. Before I hand it over to Chem, I'd just like to say that, when you look at emerging markets, 80% of it, or 75 to 80% is in Asia. And Asia's done a very good job at handling the slowdown. Asia is in the midst of a recovery. It looks like a V-shaped recovery. The consumer is still slow to come back, but is coming back. The rest of the economy has bounced back. So we're pretty positive on how emerging markets have dealt with COVID. Over to you, Chem, on the macro.
Yeah, thank you, John. Thank you, everyone, for joining us tonight. I've been an economist for 30 years, and I certainly haven't seen anything like this before in my career as an economist. It all started, as you all know, with a significant global labor supply shock, where people were falling off of work, and that's why economies start to slow down rapidly. But as John said, we think that emerging markets are actually situated quite well to weather the storm as far as COVID is concerned. And we are seeing lockdowns being eased across both developed markets and emerging markets, and more will come in the next several weeks. So the labor supply shock is gradually correcting itself. So naturally, then all attention turns to stimulus that is being put in place to support demand going forward. And this stimulus is being put in place both in developed economies and in emerging markets. So I want to talk a little bit about that. So let me turn to this slide that we have here. This is mostly about monetary stimulus that's being put in the advanced economies. The blue line is the combined balance sheet of the Federal Reserve and the European Central Bank in $1 billion. And the red line is the cumulative capital inflows to emerging markets starting from January 2006. What we can see from the chart is that when the balance sheets of Federal Reserve and ECB expand, that sooner or later trickles down to emerging markets, and that liquidity flows into emerging markets in the form of bond and equity flows. That happened during the first quantitative easing, which took place in late 2008, and then it carried on in the second quantitative easing, the third quantitative easing, and now towards the end, at the very right of the chart, you see that there's a significant jump in the combined balance sheet of these two central banks recently. This chart is has data as of the second week of May. So since then, we've actually had even more increase in the balance sheet of these central banks. If you were to compare these quantitative easing episodes, the current one is already larger than the previous one, and it's only going to get larger because both of the central banks have committed to injecting more liquidity. We have seen significant outflows from emerging markets until about middle of May, to the extent of $85–90 billion. But recently, bond inflows have actually stabilized. As a matter of fact, over the past 2 weeks, daily data is showing that bond inflows to emerging markets have turned positive, both for hard currency debt as well as local currency debt. And we can actually see that in yields because most of the high-yielding local bonds in emerging markets have actually rallied between 150 to 280 basis points in the past two, three weeks. So we expect this liquidity, which is going to continue to increase, to come down, to trickle down to emerging markets, and emerging market capital inflow should significantly increase over the next several months. If we can go to the next slide, please. Just to give you some idea of now fiscal stimulus that's being put in place both in the developed world and the emerging market world. There's going to be significant increase in government debt ratios in 2020, and probably some increase in 2021 as well. These are IMF forecasts for each of the countries. Let me just say that obviously times have changed. In the past, if we were to look at a chart like this and see all these countries increasing their debt ratios such significantly, that would have been a worry for us, because sooner or later, large increases in debt ratios have to be dealt with either in the form of a sharp reversal in fiscal policies or with inflating debt away. But this is a different time. All economies globally are facing deflationary risks. So we would be more concerned if they were not able to increase their debt ratios and implement their fiscal stimulus plans. So that's the angle that we should be looking at this from, because if you cannot borrow, if you cannot stimulate your economy and deflationary pressures mount, it's actually then that your debt dynamics becomes unsustainable. So if you look at across the countries, I think red bars are some of the developed economies. So the United States debt ratio is going to go up by more than 20 percentage points. If you were to compare this to what happened in the immediate aftermath of the global financial crisis, the debt ratio in the United States went up by 28 percentage points in 4 years. So just a 23 percentage point increase in the debt ratio in 1 year, that just tells you that the amount of fiscal stimulus that's being put in place in the United States this time around is much larger than what they did in the past. If you look at the European countries, I think that was a pleasant surprise for us, a complete change in the attitude of governments, starting from Germany, France, and Italy. They are putting in massive fiscal stimulus as well. And I also want to note here, another pleasant surprise coming from the European side is that, as you all know, they are also very close to implement a joint fiscal stimulus package, 750 billion. euros. As you know, 250 billion euros of that is loans, and 500 billion euros can be grants. So this is the first time that really Germany and others have agreed to mutualize fiscal policy, mutualize fiscal risks in the European space. And I think that's going to be a positive for Europe. It's going to be a significant progress towards some sort of a fiscal union in the future. So that was a pleasant surprise. Now, if you, just to give you an idea of how aggressive Europeans are being as far as stimulus is concerned, Italy, for example, in 2020 is going to have a budget deficit of 170 billion euros. And if you look at the planned net purchases of ECB, of Italian bonds, it's exactly equal to the budget deficit planned for Italy in 2020. So not only are they doing stimulus, but also on the ECB side, they have tweaked their quantitative easing rules so that, you know, money is flowing into places that it's most needed. So that's a positive as well. If you look at the emerging market universe, there are some significant fiscal stimulus that's being put in place in emerging markets as well. But obviously, you know, emerging markets are a bit more constrained than developed markets. So these are all fiscal stimulus plans, and the way we look at this, the way we frame this, the way we judge what the capacity of a given emerging market is in terms of how much fiscal stimulus they can provide, we look at two things. Matt, maybe we can go to the next chart, please. So what we do here is, this is the framework that we're looking into. On the horizontal axis, you see broad money as a percentage of GDP. This is basically a proxy of the size of the financial market in the countries. The larger the financial market is, obviously, the larger is the pool of savings that the government can tap into to finance its fiscal stimulus plans. So the larger you are, the farther right you go on the horizontal axis, the better it is. If you look at the vertical axis, that measures the ratio of a country's foreign exchange reserves to its external debt. So what that does is, the higher that ratio is, obviously, you know, the country can lean against the wind in terms of smoothing volatility in its exchange rate, should it be facing capital outflows. And also, you know, if you have plenty of FX reserves in comparison to your external debt, then that means that you can actually use your FX reserves to pay off your external debt, or you can provide dollar liquidity locally to corporates to pay off their external debt. So if you look at each and every one of these countries on this diagram, obviously, the farther out you go to northeast, the better is the country's position to provide more fiscal stimulus. On the southwest corner, it gets a little tougher. These countries will be more constrained in terms of providing financing their fiscal stimulus. With capital inflows increasing, trickling down from quantitative easing in advanced economies, it should help all these economies to finance their fiscal stimulus plans and their recovery. But the basic point of this framework is that the countries that are in the northeast are in a better position. Those countries happen to be concentrated in Asia, China, Korea, Taiwan, Thailand, but you can also see that countries like Russia, India, Brazil are also in a strong position because they have large financial systems, and they also have large FX reserves in relation to their external debt. It's a very intuitive framework because those countries that have large financial systems are typically countries that have had protracted current account surplus in the past, so they have a large pool of savings that the government can tap into, and those economies also happen to be the ones that have large FX reserves because they've had large current account surpluses and they haven't had to borrow externally as much as some of the others. So let me stop there, and I think
yeah, and so John, just from the perspective of the portfolio, have you been looking to, I suppose, position the portfolio towards those countries that are more willing and able to support financial markets? And how do you think about that from a portfolio construction perspective?
Yeah, no, it's, I mean, in terms of the portfolio positioning, I mean, we have two sides of it. One, we have like the North Asian side. So we have China, Korea, Taiwan, which, as you could imagine, is more technology, more growth. But then we've actually, during this sell-off, we've added to South Africa. We've added to Turkey. We've increased our Brazil exposure. We've added to India. So, and those are going to be economies and markets that benefit from this massive liquidity. And so, and those, if you look at those markets, they're still down 30, 40, 50%, some of the stocks that we own. So as much, you know, you could look at, you know, the market, and you can look at our fund and say, well, geez, it's up a lot. I missed it. I don't think you could say you've missed very, very little of it, especially at that high risk side of it. Now, you don't want to go too far down that risk spectrum because, you know, Bolsonaro in Brazil could walk in tomorrow and fire his finance minister. Erdogan could put on capital controls, as could, you know, South Africa. So it is risky. We are in higher quality or the highest quality names in that market. We are in, you know, big liquid stocks in the market. They are market leaders, whether they're financials or industrials. And so that's how you have that portfolio positioning. And I think it's interesting because, you know, I think we could make money on both sides of the portfolio, where technology continues to do well or technology disruptors do well just because their businesses change. And then you have this whole other part of the portfolio, which is considered risky, but in this environment, you know, that tail risk is very much diminished. And so, you know, that's kind of how we've positioned it in terms of the country risk. The slide you're looking at now is the earnings growth in terms of the overall earnings outlook for emerging markets. It is actually, this is, you know, just looking at consensus numbers and combined with, you know, Bloomberg and our numbers, and you can see that emerging markets are in a much better position in terms of earnings. Our portfolio earnings growth for this year came down from about 25% to about 12%. So pretty much cut in half. Obviously that's going to be, you know, the technology side is doing well, but then obviously the EM travel or something like that's going to be dragging down the other side. When we look to 2021, the earnings growth of our portfolio is looking around 21, 22%. So good earnings growth. Our portfolio at this point trades at about 16 times earnings versus the benchmark, and that's on 21 earnings versus the benchmark at 12. So we're paying a little bit more, but we think we have very good quality companies. We have very limited exposure to SOEs. We do own some SOEs and we like them, but we have growth opportunities, we think, at a very, very reasonable price. And I think there's upside to that growth number as well.
Yeah, and I suppose maybe taking it one step further, in terms of balance sheets, I suppose in times of stress like we're seeing at the moment, balance sheets tend to be scrutinised even more closely. Have many companies in the portfolio raised capital recently, and have they experienced any issues with accessing capital markets?
Yeah, so early on in basically February, March, we took a very close look at our portfolio companies, and there were two companies that we thought were slightly levered for the environment. One was CPL in Thailand, that company announced an acquisition probably at the wrong time, taking on $3 billion of debt, and the other was a petrochemical company, which obviously is cyclical. The leverage of our portfolio is basically, it's compared to the index leverage is about 1.8 times debt to EBITDA. Our portfolio companies is negative 0.4. So our portfolio companies have net cash positions. So we think our portfolio companies are in very good position, even though we have that tail part of the exposure. We have seen some companies, we've seen especially two of the travel related companies. One of them did a convertible where there was very, very strong demand. The stock is up 50% in the past month. The other is a hotel operator, and they actually tapped European financing at 2%. This is a company that, you know, basically is shut down. It's in throughout Europe and it's throughout Asia, minor international, and they got 2% funding for, I think 300 million euros. So what we've seen is companies are able to access liquidity, but we haven't probably seen the low quality being tested yet, Luke.
Right. And Chem, I know you touched on capital flows already, but I suppose I'm interested in what's the view on the impact that this has had on equity market performance, and is there an expectation that those outflows will reverse in the near term, and any catalysts that you're looking for in that respect?
Well, definitely. I think I mean we've already seen, as I said before, bond flows sort of stabilize, and actually over the past 2-3 weeks, bond flows have actually turned positive. Equity flows, the outflows have subsided, and we are expecting this to turn around very soon, because the outlook for emerging markets is definitely improving, with more and more liquidity being pumped in by these advanced economy central banks. But let me also say a few things about what the risks today in the emerging market are compared to where they were, say, in the aftermath of the taper tantrum or some years ago. To look at, for example, this slide on emerging market external debt. So this is a slide that looks at the total of government and private sector external debt in emerging markets, and the red dots show you where the debt ratio was 5 years ago at the end of 2015, and the blue ones are as of the end of 2019. That's the latest available data that's compiled by the World Bank, and is comparable across all emerging markets. And you can see that most of them I can say a few words about the absolute level of the debt ratio, but let's first take a look at the change. There hasn't really been much of an increase across emerging markets. Most of them are stable. Now, if you were to look at the ones where the debt ratio has actually increased, the two that stand out, if I can show here, are Turkey and South Africa. So these countries, the reason why their debt ratios went up is because they had large current account deficits over the past 4 or 5 years. Those large current account deficits have now completely evaporated because growth slowed down these economies, and therefore their imports have been compressed. Some of the other economies that saw increase in their debt ratios, like Chile or Colombia, or those are the two ones that actually stand out, is that they're commodity exporters, and commodity prices have been depressed for several years now. So with the commodity prices picking up a little bit, I think those economies should do better as well in terms of their external debt ratio. And one also has to look at into details where the owners of debt in emerging markets. For example, if you look at Hungary, you can easily say that with an external debt ratio of 90%, that this is very high and that it could be risky. But two things to note here. One is that they've actually deleveraged from over 120% down to 90%. But also, like I said, if you were to look in the details of the debt holders, half of Hungary's debt is actually intercompany loans. So it's basically lending from parent company to its Hungarian JV, and mostly in the manufacturing industry, which those are typically loans that have a much higher probability of being rolled over. So in my opinion, with the exception of a few emerging markets, I think the external debt ratios have been largely stable and don't pose a huge risk going forward. I also want to say a few things about current account deficits and exchange rates. So if we can please move to the next chart. So this is emerging market current account balances as percentage of GDP. Obviously, to the left of the chart, we can see that there are a number of emerging markets that have large current account surpluses. The red bars are where the current account balances were in 2013, right before the taper tantrum, and the blue bar is where they are at the end of 2019. So if you look at the right of the chart, most of the current account deficit countries, the current account deficits have actually adjusted and declined significantly. For example, if you look at Turkey, which is over here. It had a huge current account deficit, close to about 6% of GDP, which has now actually switched into a surplus because of import compression. These economies here, you can see that there's been significant adjustment in their current account deficit. Of the ones that where the adjustment has not been so significant, or where the current account deficit is maybe still a little bit higher than what can be easily financed, are again Chile and Colombia, where commodity prices have played a significant role in these current account deficit dynamics. But overall, I think you can easily tell from the chart that current account deficits or current account balances in emerging markets today are in a much better position than they were right before the taper tantrum. And finally, on the next slide, I want to say a few things about emerging market exchange rate. As you all know, if you look at nominal exchange rate, the broad nominal exchange rate of emerging markets vis-a-vis the US dollar, it's been actually weakening since the late 2017, which is when the trade wars began. And lately, over the past couple of weeks, there's been a recovery. But the best way to actually judge whether a currency is competitive or not is obviously, as you all know, is to look at the real exchange rate. And my preference is to always compare the current level of real exchange rates to what they were during the global financial crisis, that is to an average during 2008 and 2009, because we all know that then there was a massive dislocation in nominal exchange rates. There was massive overshooting in nominal exchange rates, and we know that at that point, all emerging market real exchanges had fallen into very, very competitive levels. So if you compare it to the blue line compares the current real exchange rate to what the average was during 2008 and 2009, you can tell from here, starting from here, most of these economies actually have even more competitive levels of real exchange rate compared to 2008, 2009. I mean, look at Turkey's, for example, it's 25% lower, Philippines, Colombia, Russia, and so on. A couple of these economies here may look like they're a little bit extended in their real exchange rate, perhaps not as cheap. Indonesia has always been a very controversial place to measure the real exchange rate. Different measures show different valuations, but and the nominal exchange rate has rallied a lot recently. So I would say they're probably a little bit far out and misaligned and a little overappreciated. But in general, I think most of the emerging markets have very, very competitive exchange rates, and I think there's a lot of room for appreciation going forward, particularly given the fact that the dollar has just started to weaken. A weaker dollar has been our expectation. Interest rate differentials had been moving against the US dollar for some time, but the reason why the dollar remained strong was because investors and markets were basically very much worried about growth outside, recovery outside of the United States, particularly in the euro area. But when both the ECB and the European government surprised on the upside with their stimulus plans, finally the market started to price in a better growth differential between Europe and the United States as well. And over the past 2.5, 3 weeks, we saw the euro gain against the dollar, and the broader dollar index, DXY, as you all know, which people pay a lot of attention to, 40% of that is actually the euro-dollar parity. So it moves in tandem with euro-dollar parity. So the euro gained, and also with the broader dollar weakness, we've seen a significant recovery in nominal exchange rates of emerging markets over the past couple of weeks as well.
Thanks, Cem. And John, maybe just before we open up to some questions from the audience, I mean, we've obviously seen a pretty significant correction in Q1 and then a rebound in the last couple of months since then. What's your view on valuations at the moment in emerging markets, and I suppose both on an absolute basis and relative to developed equity markets as well?
Yeah, I mean, I think if we look at the next slide, Matt, you know, emerging markets offer very good value. I mean, this is probably a little bit higher at this point, but I think the other thing to think about is I think you're going to tend to have more of a V-shaped recovery in emerging markets than developed markets. A big part of developed markets are going to be under these deflationary forces. So just look at, the whole work from home issue around real estate and how that impacts it. You look at retail, every other day we see a developed market retail go out of business. Brooks Brothers was today. Iconic names that are just kind of going out of business. If you look at travel, it's going to be hit really hard. So, and it's going to cost a lot for our government to continue to try to get this economy going. Whereas, emerging markets are used to being kind of poor and running on a shoestring. So it's kind of interesting, and you have that growth dynamic. Now, if you look at the next slide, we have look at the earnings yield and to the U.S. to the 10-year, and when we hit these extreme periods historically, it offers a pretty good buy signal. We're obviously at very, very, very low 10-year yields, and we think we're going to be at low yields for a very long time. But again, this is kind of looking pretty obvious. We don't know what the upside is going to be this time, but I think everything's setting up for it to be more like 03 to 07 than the other two periods here. I mean, when I look at the dollar, when you look at commodities, when we look at where we're going to get the next growth leg globally, I think it's going to be emerging markets, and it's an asset class that's very under-owned. And finally, we have one other chart looking at kind of yields and how yields drive it. And this basically it's a carry index. So basically when it's going down, local bond yields are going up in emerging markets. And we've just had a correction. And as Cem mentioned, EM debt flows are starting to come back. And I think, they're going to come back and they're going to stay in EM for quite some time because there's no other yield pickup. I mean, even the Fed is buying US junk bonds. I mean, this is pretty historic. So when you want to have pick up a yield of 600, 700, even 1,000 basis points, the only place to do that is going to be in EM debt, and that's going to be very supported by the global liquidity. So I think the market is set up to do really well. I think the technicals are set up to do really well, and I think the beta of our portfolio and our exposure is very much going to capture that upside as we have, and we have done a pretty good job at capturing upside in bull markets. And I think the portfolio is very well positioned to capture that, Luke.
Yeah, thanks, John. And just on that note, before I open to some questions, just the slide on screen now, just as a quick reminder, and for no other reason than to state that, the performance of the strategy is there for everyone to see. The guys have managed the strategy through a range of market cycles over the last 8 years, and invariably they've tended to do a very, very good job coming out of these sort of correction periods we've seen in the past. So we're hoping that we can see a repeat of that in the months to come. But the benefits of having a disciplined and tried and true process tend to come to the fore at these points in time. Okay, so on that note, we've got some questions from the audience. The first one that's come through is from Dustin. Dustin's asking, do you see some of the easy returns are now past us? And do you think that stock selection and risk assessment are even more important now than previously?
I would say, anytime you look at a market bottom, it's easy to say the easy money's been made, but, unless you're long going into it, or unless you're pretty lucky, it's pretty hard to capture that. I think, in my investment career, where you've made the most money is in the middle part of the recovery. And that basically, would be from here on the way up. So it'd be, similar to 16, 15, and 2016, coming out of that difficult period in emerging markets, you probably didn't want to come in at the end of 15, but into 16 after it had rallied, then you went on to make almost 100% or more, and the fundamentals kind of supported it. I think we're in more of a phase like that. Now, could you get a pullback like we saw last week in risk? Of course. But I think the risk reward at this point, with all central banks, with governments looking at fiscal, are very much focus risk. And it's not just emerging markets. I mean, copper, we're very constructive on copper. I think you look through the commodity complex, even in the PGMs or in precious gold, I think is set up to do well, which is a beneficiary for places like South Africa or Peru. Oil, we think, oil has recovered. We're back in almost the 40s on Brent. People said it was going to stay at 25 forever. We had oil trading in the futures on a negative basis. So I think we're in a risk environment, and if you think about emerging markets, they tend to be at that riskier spectrum, and then it's also performed for the past decade and is relatively underowned. If you look at the Morgan Stanleys of the world, Goldman, JP, they're all kind of getting behind emerging markets, which I find really interesting. So even though they missed the bottom, and even though they were bearish at the bottom, they are supportive at this point on EM equity and EM fixed income.
Great. Another question here, interesting one from Graham. There's a big debate in the US at the moment on the impact of millions of new retail investors via Robinhood entering the stock market. Are emerging markets facing this new activity as well, and is it having any impact?
Yeah, in terms of, we are seeing basically the higher, the stocks in the technology disruption theme, or in the tech space, especially the ones that are listed in the US, the ADRs, are seeing that phenomenon. So Mercado Libre, a stock that we own, 3+% position, hit an all-time high. The stock has done phenomenally well. It's up 50, 60, it's up 60% year to date. If you look at our Chinese internet companies, some of them are 30, 40%. So yes, you are seeing some of that. I would say it's not brought down to the local level yet, because you haven't seen that liquidity come in, but I think that probably is the next phase. Just last week we saw the S&P down 5.8% or so on Thursday. That evening in Chinese trading, the A share market was up. So the liquidity is definitely seeping in and will continue to seep in, and I think it's going to be a market that's going to be, I think it's very interesting and very exciting, because I think it could be very, very powerful. And the fundamentals are more positive than other times, just because if we have a short slowdown and we don't have a credit correction, if we don't have a credit event, then that means just we're in a relatively good economy. It might be slower, with an enormous amount of liquidity chasing fewer assets, and that's pretty interesting dynamic.
Great. And I suppose we couldn't have a webinar without at least one question on US politics. A question from Gary here. US elections are going to get increasingly more focused as we near election day. Are there any stocks in the portfolio that would be expected to benefit or suffer from either a Trump or Biden victory? And how do you manage those sort of risks in the portfolio?
Yeah, in terms of, so we had a call with Rice Hadley Gates last week, and as Bob Gates said, well, the election doesn't really start until after Labor Day. Labor Day is September 7th in the US. So, you hear like, you're going to see polls, you're going to see people saying, oh yeah, Biden's ahead by X amount. There's going to be an enormous amount of noise. So I think it's useless focusing on it right now until we get up to that period. Where we are concerned on US politics impacting our portfolio is US-China. And we actually think that it's not a trade war, it's a technology war. And so we are reluctant to have hardware or even software exposure in China that would potentially be impacted by sanctions, potentially impacted by them not having access to the US market. Their officers could be sanctioned, so it could materially impact their business. There are publicly traded companies out there that have that risk. And then, as I mentioned, our SOE risk within China is relatively small as well. So that's really where we would kind of be concerned in terms of the US politics.
Yep. Okay, I know we're getting towards the end of the time, but I just want to squeeze one more question in here from Dustin, and Chem, you might like to weigh in on this one as well. But Dustin asks, is it fair to say that the lag between easy US money and EM flows is approximately 6 to 9 months? And do you think it will be faster this time?
Yeah, that's actually a good question. Actually, it's a one that can be easily answered by looking at the chart that I showed in the beginning of the talk, but let's not go back there, and let me just say verbally. During the first quantitative easing, it did take about 6 to 9 months for inflows to emerging markets to really accelerate. There were outflows for some 3-4 months, and then it kind of bottomed out, and then starting from the 6th or 7th month, it started to go up rapidly. But interestingly, in the second quantitative easing, inflows actually started to go into emerging markets before the second quantitative easing program was announced. So it actually went up in anticipation of further quantitative easing. The same actually goes for the third quantitative easing as well. So the so-called Fed put, right? Everybody's expecting the Fed to go out there and do what it takes to prop up the financial markets, because, you know, at the time, that's all they could have done to prevent the economy from slowing down. This time around, I think that effect is even larger, in the sense that they came up with a unlimited quantitative easing. They broadened the scope of quantitative easing, right? In the previous episodes, they only bought government treasuries and agencies, but this time around, they're also taking on private sector debt, but they also have facilities where they're going to be lending to the Main Street. They've already started that a little bit with their Paycheck Protection Program, but also today, the other Main Street facilities went into effect, where they're going to be actually not directly lending, but the banks are going to be lending to the Main Street, and they can turn around and sell those loans, 95% of those loans, to the Federal Reserve. So the scope is increased, forward guidance is much stronger, and just last week, or a couple of weeks, there was some pressure on the long end. The yield curve steepened because people were concerned that Federal Reserve was going to scale back its treasury purchases, which is what we had seen over the past couple of weeks. If you look at the weekly purchases, and Powell came out a couple of days ago and basically said that they're going to put a floor on treasury purchases at the current rate. So that's even stronger forward guidance. So I would suspect that the markets now fully believe, and they have high conviction that Fed's going to do whatever it takes to have the markets continue to function and to support the recovery. And therefore, I would expect that the money will trickle down to emerging markets sooner than later.
Fantastic. Certainly plenty to think about. Well, thanks again, everyone, for joining, and thanks, John and Chem. I should also mention, I think Chem gets the award for being the most socially distant person in the universe at the moment. So hopefully, stay safe, man. Hopefully we'll get you back to planet Earth shortly. But no, thanks again, everyone, for joining us. Hopefully that was useful. Contact details for the team are on the screen now. Please feel free to reach out to any of us with any follow-up questions. There's a few questions we didn't get to today, but we will get in touch with you guys individually, and hopefully we'll get John and possibly Chem back down to Australia sometime in the near future as well.
Yeah.
Thanks again, guys.
Have a great.
Thank you very much.
Thank you, everyone.
Thanks, Luke. Thanks, everyone. Take care.
Have a great day. Bye.